Hello and welcome to Thank God It's Friday. This week we'll be joined by Mahesh Nandurkar, the India strategist with CLSA, and we're here to discuss his views on the markets and his favorite sectors. Thank you for joining us, Mahesh.
Thank you very much.
Mahesh, the Nifty has gained about 11 to 12% so far in 2017 to about 9,100 levels that it currently trades at. CLSA's target for March 2018 stands at 10,000. Considering that this rally that we've seen in 2017 so far, and that the fact that it probably could have priced in all the positives, whether it been the overestimation in the initial days of demonetization or the Trump-led fears, what is it that will drive the next 1,000-point rally that you're expecting in the index?
Well, I think that over the last couple of years, what we've seen is the corporate earnings growth has generally been weak.
Right.
We have, seen barely, single-digit corporate earnings growth over FY17, also FY16, as well. And there are reasons as to why that happened. But we believe that FY18, which is the current financial year, the earnings growth will be much better. We're expecting at least about 13 to 15% kind of earnings growth. So I take your point that the valuations have indeed are at a premium level. So one can't really expect much returns from further increase in the P multiples themselves.
Right.
But I think the earnings growth will be the key driver in my view, and that should be able to drive about a 10% plus kind of a return over the next 12 months.
So if you were to segregate the market into index stocks and relatively smaller stocks, that is the mid-cap space, how do you view valuations in both these areas? And based on your expectations of earnings, where would you place your bets for this coming year?
Right. So if we look at the overall Nifty valuation at the index level, we are probably at about 17.5 times 1 year forward earnings, which puts us roughly 10 to 15% higher than what the last 10-year average has been. That's
Right.
for the large cap index Nifty. Even if you look at some of the mid cap, small cap names, most of these companies are trading well above their historical averages. In fact, if you look at the long-term analysis, then we usually find that the mid-cap, small-cap stocks, on an average, usually trade between 15 to 20% discount
Right.
to the large caps. That discount doesn't exist anymore.
Right.
So not only that we have large cap trading at above the average levels, the mid-caps are trading in line with the large caps. So.
Right.
To that extent, one can easily argue that the valuation in the mid-cap space
Right.
is much more expensive relative to history than the large-cap space. But I would, not make a judgment, just on the basis of, where the current valuations are,
Right.
Vis-a-vis history, because then there are a lot of other factors as well. And I think one big factor that we have to keep in mind when you talk about the overall, P multiple analysis is that where are we in terms of the corporate earnings cycle,
Right.
in
Right.
terms of the overall profitability. So currently, the average corporate ROEs are not really that high. We are at about 15 to 16% range, which is well below their historical averages.
Right.
If you look at these numbers in a slightly different way, say the corporate profits as a share of GDP, something that a lot of people track in the developed markets, but I haven't really sort of seen people talking about this term here in India. But that I think is a very important sort of indicator as well. So we, in India, if you look at the corporate profit
Right.
as a share of GDP, we are close to an all-time low.
Yeah.
So clearly, while the PE multiples are on a higher side, the corporate profitability is on the lower side.
Lower side.
And so that's the reason why I believe that over the next few years, the earnings growth will be significantly better, and which kind of justifies the current valuations that we have.
Okay, so based on the initial estimates from SkyMet and IMD, we have an expectation of a normal monsoon for the second straight up year. What are the best themes that you can think of with respect to the monsoons coming in normal for the second consecutive year?
Well, I think it's a very important factor because not only that we have a second consecutive year for monsoon, most likely, But also if you look at the strategies, and the targets of the government, both at the central level and at the state level,
Right.
the focus clearly is towards, more on the social sector, more on the rural development. I
Right.
mean, we have things like, the social housing, irrigation, rural roads, etc.
Okay.
Which is really at the forefront of the government strategies. So I think it's a combination of both the government trying to increase its spend, on the rural side, and the bottom end, of the pyramid. And also, as you rightly mentioned, most likely the second consecutive, average monsoon. We believe that this should help the rural wage growth, from the current levels. For the last 2 years or so, we have been looking at rural wage growth moving at around 5 to 6% range. That should, be moving upwards from here on. I would say that some of the consumption sectors, like the staples,
Right.
like the consumer discretionary, which is basically autos, medias, and some of the other, related things like, branded apparel, the building material segment, because it not only derives the demand from the rising rural incomes, but also it fits in nicely with the, with the social housing scheme which the
Right.
government is, clearly focusing on. So I would be focusing on, let's say, the social housing scheme, which will, I think, be the intersection of both
Right.
the rural incomes as well as, what the government is trying to achieve. So the whole host of stocks, whether it is housing finance companies, building material companies within cement, or some of the other ones who are into the building material category,
Right.
would be the ones to look at. The staples, while it looks as an obvious beneficiary of this, and I'm sure they will benefit, but at some point in time the valuation
Right.
will begin to be a constraint for some of these names. So I would basically would play it through the autos, media, and some of the names that
Okay.
I've mentioned.
Right.
All right, you just addressed the housing finance companies, and I want to talk a little more about that. Do you see further scope for housing finance companies to see an expansion in their multiples or stock prices, given the continued thrust of the government on the affordable housing theme? And again, your thoughts on which would be a better play, a better way to play the affordable housing scheme, whether housing finance companies or real estate? Let's talk about housing finance companies.
Yeah, no, I think housing finance sector is very nicely poised, at this point in time. So I think we have the twin factors which will be helping the housing sort of market going forward. One is obviously, as you mentioned, the government support for the affordable housing scheme, and the fact that they are offering some housing loan subsidies and some explicit cash subsidies as well for the houses in the rural areas, urban areas, etc. That's one.
Right.
Secondly, is also the affordability in itself.
Right.
So over the last 4 to 5 years, the property prices haven't really gone anywhere. They have been more or less stable, or maybe moved up in like single digit range over the last 4 to 5 years. But at the same time, the per capita income, however, has grown by almost 8 to 9% annually over the last 5-6 years, which has been the trend in India for the last several years. Plus, we have seen from the peak, the mortgage rates have come down by almost 200 basis points, and plus this housing loan subsidy, etc. So if you look at the affordability chart as to what a typical sort of household that would be looking at buying house, let's say in the range of 2 million to 5 million, say 20 lakhs to 50 lakh kind of a range, which I would call as an affordable segment. The affordability ratio probably today is at the best levels that we have seen in the last 2 decades.
Right.
So I feel that as a combination of this affordability and the government support, both is an ideal combination for the housing market in general to start reviving from where we are. Obviously, you would say that at this point in time, whether the housing markets are booming, the answer is no.
Right.
Because obviously we are just about recovering from the demonetization and so on.
Yes.
So it's going to take some time. But if you take like a 3-year to 5-year kind of a view, I think this is one segment that will benefit quite a lot. and what better way to play that other than the housing finance companies.
Right.
All right. You were for the same reasons that you've given in favor of housing finance companies, and like you mentioned, the real estate sector, because that has really thrown up a big surprise, especially this being the sector which was thought to be taking the biggest knock from demonetization,
Right.
has surprisingly done very well. It has been outperforming. Of late, we've also been hearing that companies are looking to unlock value from their commercial assets. Are you looking at any such names in the realty space?
See, I'll not be able to comment on specific stock names,
Sure.
but if you look at the real estate development space in general, obviously, we have seen like several years, of not that great a performance, in the stock prices, and also, in some of the fundamental performance as well. If I were to sort of look at this scenario which I just painted, that the housing market should be reviving over the next 3 to 5 year period, I still feel that the housing finance and the building material is still the better way to play that, because if you look at the listed space, then the number of companies that are really operating in this affordable segment are not that many, or maybe the proportion of income that comes from that segment is not all that. So most of the listed sort of companies are targeting the premium end or the luxury end of the segment,
Right.
which will take longer to recover in my view. So there will be some select companies, but as a category as a whole, I would still prefer, as I said, housing finance or building material.
All right. Okay, then let's also talk about the banking space. The RBI has done a second asset quality review of sorts with its directive on providing more for the stressed assets that it came out with earlier this week. In addition, we're also expecting some NPA policy framework to come up. Does that really mean that the worst is not yet over for the banking sector and the balance sheet cleanup? And could we be headed for an earnings shock, especially with respect to PSU banks?
Yeah, it's a very good question, and it's a fairly new thing. That AQR2 is a fairly new thing which has just recently come out earlier in the week. Which was a bit of a surprise. But having said that, I would generally say that the NPL cycle, I feel, is close to peaking.
Right.
So currently we are at about 11.5% of the total outstanding credit, which is classified as an NPL. Maybe that number goes up by a few percentage points, but I don't think we are going to be in for anything even I would say remotely close to an AQR kind of a shock that we saw a year ago. Also, I would say that even that AQR in itself, was not really a shock, because the market, had already kind of anticipated or knew that the actual asset quality is not as good as it's been made out to be, and the investors are already factoring in incremental level of NPLs. Now from here on, what I would say is, you talked about the sort of state-owned banks, the PSU banks. Well, those banks will still be more vulnerable. If this actually doesn't turn out to be the way I just mentioned, and if indeed NPL problem turns out to be sort of worse than what we just discussed right now. So I still feel that a much better way to play the banking sector is still through the private sector banks. And within private sector banks you have the retail oriented banks and the corporate oriented banks. So in sort of times to come, as the NPL sort of pressures abate, the corporate oriented banks will get that relief on the private side. Having said that, some of the smaller private sector banks, where we still see enough growth opportunities. I mean, the credit growth might be struggling in 5 to 10% kind of range, but some of these smaller private sector banks will still continue to grow in the range of 15 to 20% very easily. And the simple logic for that is, we are working in an environment where of the total outstanding credit, private sector has only 25% market share, right? And the government-owned banks have 75%.
Right.
So there is still a lot of room for private sector to grow and gain market share.
Right.
And especially now that look like there is that AQR2 kind of a situation, I feel that some of the smaller government-owned banks will struggle to grow, in line with the industry, because clearly they don't really have enough capital. So I think the private sector is still, in my view, a better way to play the financial space.
Okay.
Fair enough.
Anything that you'd like to absolutely avoid right now with respect to themes?
See, absolutely avoid. So you have two types of stocks, right? One which is doing quite well.
Right.
The fundamentals are good, the growth is reasonable, and then there is like appropriately higher valuation as well.
Right.
And then you have some of the stocks or sectors which haven't done well. That includes IT, pharma, industrial, real estate. Although real estate has moved up a little bit over the last few months. So there are these two types of names. So you clearly have the valuation comfort, on the second side.
Right.
So I would say that within that, maybe IT looks, a bit more promising.
Okay.
Because I think there is a lot of pessimism,
Right.
around that space. So that looks interesting. Whereas in case of healthcare as a sector, we continue to sort of maintain an underweight stance. There will be some select companies where the things could be looking up, but by and large, I would keep an underweight, on the healthcare space. If you will ask me, if I take a longer term view, like a 3 to 5 year kind of a view, then even staples, is something where I would be a little bit cautious.
Right.
Because over the next 3 to 5 years, what I'm expecting is a kind of a trend reversal. And what I mean by that is the last 5 years, we've seen the capex cycle, the property cycle generally being weak.
Okay.
I feel things will reverse, and you will see better infrastructure spending, capex spending,
Right.
and the housing. So some of these sectors will look better over the next 3 to 5 year period.
Okay.
And at the same time, something like staples, which was used by investors more like a place to hide.
Right.
The money will start to flow out of these sectors into some of these sectors over the next 3 to sort of 5 year period. So I'm not saying that
Right.
it's going to happen like tomorrow or in the next 3 months or
Right.
so, but if one takes a longer term view, then even staples also looks kind of on the more expensive side, where the returns will be subdued.
All right.
Absolutely. Mahesh, one more question. Do you see some play in the financial services companies, especially given the increased traction that we are seeing in terms of retail inflows into equities? So whether you talk about brokerage names, asset management companies, insurance companies, or even those catering to asset reconstruction, could the financial services pack see an increased interest going forward?
No, it surely will, because thankfully what has been now in India is that finally the households are slowly shifting away the savings pattern from physical assets to financial assets,
Right.
right? Whether
Yes.
it is in the form of equities, whether it is in the form of insurance products or whatever. And that's a very encouraging trend, and it's also good for the economy, because if you lock up a large part of your savings in some land parcel somewhere, or even in gold for that matter, it doesn't really help economy, because if it's gold, then actually money is going out of the country.
Right.
If it's land parcel, it's just a dead money which doesn't create any jobs or whatever. So the fact that the money is coming to the financial market is really a welcome thing, from the overall economic perspective. And I think what is driving that is also the government's focus on inflation. And now we are seeing for the first time after a very long period of time that the financial assets are giving real returns adjusted for inflation, which wasn't really the case for if you look at the late 2000 or let's say even earlier part of this decade. So I think the focus of inflation is really key in that aspect. So long as the inflation remains under control, and so long as the investors get real returns from financial savings, the money will continue to flow in. And whether it comes in the form of, as I said, equities, debt, corporate bond, whatever it is, it's all good. And we have now a reasonably sort of growing the financial services sector here in India, and there are some financial services conglomerates, the local and the domestic sort of local the financial conglomerates, and they are kind of in a very well positioned to tap into whatever growth opportunity
Right.
that this trend might throw up, whether it is, so today it could be like housing finance, or tomorrow it'll be equities, or like the private wealth management and so on. So yes, I agree that it's high time India creates its own Morgan Stanley and own Nomura's and things like that. So yeah.
Okay, so these conglomerates should hopefully do well.
Yes, I think so.
Okay, so we have a fairly young audience. We're addressing a fairly young audience, and we often get this question about putting in money based on just intuition. So my question with that is, what is the trade-off between use of human intuition with respect to calculated reasoning when one goes and prices a stock in today's day of trade, in today's day and age?
Yeah, well, okay. So I'm a fundamental analyst.
Yes.
I have spent like more than 15 years, doing this. So I would clearly say that a calculated, reasoning, probably has an upper hand, in my view.
Right.
Especially in markets such as ours, which is still not that well penetrated.
Right.
Where there is still some element of information sort of asymmetry, and if I were to kind of take sort of one step back, I would say even sort of if you talk about intuition, what is intuition? I mean, there is some reasoning at the back of your mind.
Right.
I mean, the intuition just doesn't come just like that. I mean, there is something at the back of your mind.
Yes.
Well, if you're able to express that very clearly, you say
Right.
it's logical sort of reasoning.
Right.
If you're not able to express it very clearly, you say it's my hunch or it's my intuition.
Yes.
But there is some reasoning that always goes behind, I think, every intuition, in my view.
Right. Right.
So I would say that it's always better to do some some maths, some analysis, rather than just jumping into something because somebody has told you, or and I think if you look at the sort of the track record of the Indian mutual funds industry, I think I would say maybe 80 to 90% of the mutual fund schemes have been able to outperform the benchmark, the Nifty. So why should one take that intuition based decision when you have an established track record where you have a reasonable chance of doing better than what the market has done.
Right. Fair enough. And of course, my final question is, we all have our hobbies, we all have our influences. I want, well, if you could tell us a little more about what has influenced you in your life outside fundamental analysis that you may apply to your job every day.
Well, I think outside of fundamental analysis, I think one very important thing is, I would say, patience.
Right.
And not to get carried away, by the market sentiments, in itself.
Right.
Because what one is sort of, or what one can do is when the markets are rising, and you see maybe your friends and your relatives are kind of making money, and and you just keep thinking that okay, I'm late, and whether I should buy now, and then somebody gives you a tip and then you just buy that.
Yes.
I think I think those kind of temptations should be best avoided. And in fact, one thing that we've clearly learned, if you look at last 10 years, 15 years, is that most of the market crashes that we've seen in India have mostly been driven by some international factors. I mean, if you let's say go 10 years back, we had this late 2008, early 2009, the global financial crisis, and then you had late 2011, you had this European crisis where the with the pigs countries, or the so-called pigs countries, and the Greece, so there was some issue and the market crashed. And then you had the taper tantrum in the middle of 2013, and then more recently, we had China-related concerns in middle of 2015, early 2016. So a lot of these crashes have told us or taught us that these are the times when one should sort of be taking a slightly contra bet,
Right.
You know, and you know, if you've done your analysis, if you have kind of, you know, like figured out, okay, this is you know, one stock or one sector that, you know, I like, then the market does give you opportunities. I mean, if you look at these like last sort of 10 years, then it has given you opportunities at least 6 or 7 times.
Right.
So and when this opportunity comes, one should take it.
Yeah.
And you know, not get once again bogged down by the market sentiment that, oh, everything is looking so bad and things like that. So yeah, I guess these are some of the small things that you know, I think the time and the market
Right.
you know, has taught us outside you know, of just the fundamentals. So I think, yeah, so this is something that I think all of us should keep in mind.
Mahesh, it was a pleasure speaking with you. Thank you very much for your time.
Thank you very much for having me here. Thanks a lot.
Thanks a lot.
Mm.